Are you someone who's struggled with investing? Feeling overwhelmed, lost, or even intimidated by all the advice out there? Imagine finally cracking the code to growing your wealth, building a future you're proud of, and having the confidence to make smart financial decisions. But here's the catch. If you don't figure this out, your money could stay stagnant, or worse, shrink while others build wealth and financial freedom. Now let me tell you, investing used to feel impossible for me too. It was confusing and full of mistakes. But everything changed when I discovered these 5 secrets, and they can change everything for you too. In this video, I'm giving you no BS secrets that work. Real, actionable strategies you can start using today. No fluff, no filler. So let's get right into it. Secret 1. I still remember the first time I lost money in the stock market. It wasn't because I picked a bad stock or didn't do my research. It was because I panicked. The market started dipping, and every headline screamed crash. My fear got the best of me, and I sold everything at a loss. A few months later, those same stocks rebounded, but by then, I was out of the game. Sound familiar? Looking back, I realized my biggest mistake wasn't choosing the wrong investment. It was forgetting the one thing that could have saved me. My time horizon. You see, I wasn't investing for next month or next year. I was supposed to be investing for the long term, for years, even decades. But in the moment, all I could see was red numbers on a screen. I let short-term fear rob me of long-term growth. That experience taught me a lesson I'll never forget. Your time horizon, or in other words, how long you're willing to stay invested, is your greatest superpower. Here's why. If you're in it for the long term, say 10 or 20 years or more, then market downturns, they're just noise. Those ups and downs that cause so much panic in the short term smooth out over time. Think of it like flying above the turbulence. While everyone else is panicking, you're cruising, letting compounding work its magic. But if you're in it for the short term, less than 3 years for example, the stakes are different. You can't afford to ride out those market dips because you'll need the money soon. That's why it's smarter to park your cash in safer, less volatile options like short-term bonds, money market funds, or high-yield savings accounts. Rebalancing is key, however. Over time, your goals or timeline will change, and your strategy should too. If you're getting closer to needing the money, like for retirement, it's smart to reduce the risk. But if you're young, like I was when I panicked, you can afford to take more chances and ride out the turbulence. The funny thing is, most people focus on the stock or the fund, but they ignore the most powerful part of the equation, time. And when you use it wisely, it's like having a cheat code for investing. That was the first secret. Your time horizon is your superpower. But here's the thing, just having time on your side isn't enough. What happens when the unexpected strikes? What if a single bad decision wipes out years of growth? That's where the next secret comes in. In the second secret, we'll talk about how to build a portfolio that can weather any storm, because diversification isn't just about stocks and bonds. Stay with me. Secret 2. When I first started investing, I thought I was diversified just because I owned a few different stocks and some bonds. But then the tech bubble burst, and I realized that my portfolio wasn't as balanced as I thought. All my investments were tied to one sector, and when it crashed, so did my returns. That's when I learned that true diversification goes much deeper. Here's the truth. Diversification isn't just a fancy buzzword, it's your safety net. But it's not just about owning stocks and bonds. Let me break it down. 1. Geographic diversification. Think beyond your home country. What happens if your local economy hits a recession? Because if your local economy hits a recession, other countries might still be thriving. While one market is struggling, another is handing out gold stars. By investing in companies or funds that operate worldwide, you can reduce your risk and tap into growth from places you never imagined. 2. Sector diversification. Let's be real. Putting all your money in tech stocks feels exciting, like rooting for the star quarterback. But what happens when tech hits a rough patch? You don't want to be the investor sitting on the sidelines with nothing but busted gadgets. Instead, spread your money across different industries: healthcare, energy, consumer goods, and even good old boring utilities. Think of it as building a financial buffet. If one dish or sector turns out bland, there are plenty of others to fill your plate. And trust me, nothing feels better than saying, "It's okay, my utilities stocks are holding steady," while everyone else is panicking about the next tech meltdown. 3. Asset class diversification. Stocks and bonds are like bread and butter. They're great staples. But who wants to eat just that every day? Add some spice to your portfolio. Explore real estate, commodities like gold, or even alternative investments like REITs or peer-to-peer lending. These asset classes can protect you when the stock market gets volatile. The power of diversification lies in creating a portfolio that can stand strong no matter what's happening in the world. It's not about chasing the hottest trend, it's about protecting yourself from the unexpected. But here's the thing, even the best diversified portfolio can fall apart if your emotions take control. And that's what we'll dive into next. Because no matter how smart your strategy is, and as much as we hate to admit it, your brain can be your biggest enemy when it comes to investing. Stay tuned for the third secret. It's a real game changer. Secret 3. Have you ever made a money decision and thought, "Why did I do that?" Well, welcome to the club. Emotions have a funny way of turning logic into chaos, especially when it comes to investing. Fear tells you to sell when the market drops, and greed whispers, double down on this hot stock. But here's the kicker. Your emotions are terrible investment advisors. That's why behavioral finance, or in other words, how your mindset affects your money choices, is often the missing piece in successful investing. Here's how you beat your brain at its own game. Start by creating an investment plan, a clear written roadmap that spells out your goals, risk tolerance, and strategy. This plan isn't just for show. It's your anchor when emotions start pulling you in every direction. Did the market just drop 10%? No problem. Your plan already anticipated those swings. Next, let automation do the heavy lifting. Set up automatic contributions to your investment accounts. Weekly, monthly, whatever works for you. Why? Because automation is like having a robot investor that never panics or gets greedy. It keeps you consistent, removes the temptation to time the market, and ensures your money is working for you even on days you're not paying attention. Finally, practice mindfulness, your secret weapon against impulsive decisions. Recognize when your emotions are taking control. Feeling anxious during a market dip? Pause. Acknowledge the fear, but don't act on it. Excited about a hot tip? Step back and think twice before jumping in. Sometimes just taking a deep breath can save you from a costly mistake. The truth is, mastering your mindset is what separates successful investors from the rest. But once you've got your emotions in check, it's time to tap into the real magic of wealth building. And trust me, this next secret will blow your mind. Secret 4. I have to admit, I didn't always understand the power of compounding. In fact, it felt like one of those abstract concepts everyone talks about, but no one really explains. That all changed when I picked up Tony Robbins' book, Money Master the Game. There was this one example in the book that blew my mind. It was about two friends. Let's call them Alex and Chris. Alex starts investing $300 a month at age 19 and stops entirely by age 27. Chris, on the other hand, doesn't start investing until 27, but continues investing $300 a month all the way until retirement. You'd think Chris, who invests for decades longer, would come out ahead, right? Wrong. Alex, who gave compounding more time to work its magic, ends up with more money by retirement. If you're interested in the book, I'll leave a link in the description down below, but that example hit me like a ton of bricks. Here I was, delaying investing because I thought I didn't have enough to start, while the truth was staring me in the face. Time mattered more than how much I started with. Tony's book made me realize that compounding isn't just about math, it's about mindset. Every dollar invested early is like a seed planted in fertile soil. Sure, it starts small, but give it time and it grows into something much bigger than you could imagine. That's when I stopped waiting for the perfect moment and started investing what I could, no matter how small. The beauty of compounding is that it doesn't judge your starting point. Whether you have $50 or $5,000, it rewards consistency and patience. Once I saw that, I couldn't unsee it, and I've been planting those financial seeds ever since. Now, as much as compounding is a game changer, it's just one part of the equation. The real challenge is sticking with it through the long haul, and that's where the next secret comes in. Let's talk about what it takes to keep going. Secret 5. All right, let's be real for a second. If you're expecting to get rich overnight through investing, you're in for a big surprise. Building wealth isn't like running a sprint. It's more like running a marathon, one that might have a few bumps along the way. There will be times when the market feels like a roller coaster, and you might be tempted to jump off. But the key here is patience. The truth is, it takes time to build wealth, and trying to chase quick profits often leads to emotional decisions that could harm your portfolio. That's why the best investors focus on the long term. They know that market ups and downs are just part of the journey. One thing I learned early on, and it was a tough lesson, is that patience pays off. There were times when I checked my portfolio and saw the value drop. It felt discouraging, and I thought about pulling out. But then I reminded myself that the market was like a long race. I didn't want to give up halfway through. The key is staying in the race, no matter how bumpy the ride is. So how do you keep going? Well, the first step is to stay invested. Don't let the short-term fluctuations throw you off course. Markets are volatile, and trying to time them is like trying to predict the weather. It's unpredictable. The second thing is reviewing and adjusting. Life happens. Your financial goals might change, and that's okay. Every few months, take a look at your portfolio and make sure it still aligns with your goals. And lastly, don't forget to celebrate your successes, even the small ones. Maybe you hit a milestone of investing $1,000, or you stayed invested through a tough market period. These moments are important because they keep you motivated and remind you that every step you take is one step closer to your financial goals. Remember, building wealth isn't about instant gratification. It's about consistency, patience, and staying in the race for the long haul. Earlier in the video, I talked about how investing is a marathon, not a sprint, and how patience is key to building wealth. But here's the thing, patience alone isn't enough. Without the right approach, you might find yourself overwhelmed and unsure where to start. That's why in my other video, I break down how I learned investing by myself in a lazy way. If you want to see how I made investing simple and doable, go check it out. Trust me, it'll make your journey even easier. See you there.